This is our Forex blog for August 5th, 2011. And like most days, we really want to buy the strongest currencies versus the weakest. You have very strong yen, really until about 7 it becomes, moderately weak, or actually very weak for a couple hours. There's brief half-hour periods of a little bit of weakness. But the daily, weekly, monthly trends up. You want to trade that, and the pound was also strong against some of the weaker ones. CAD, weak on all time frames today. New Zealand, and so is the Australian. Now the euro was very strong today for the most part. However, the weekly, monthly trend's down, so it's got mixed trend. So starting the day off, looking to sell the Australian yen, New Zealand yen, CAD yen, all made sense. We'll start with the Australian yen. Notice this one had already fallen a lot last night, and it's underneath the hourly. It's also right down near a fib retracement area. The next likely low is the Fibonacci profit target level, which is also lined up with a monthly pivot level. Now it's not that far away. It's always a better trade when you get a pullback up to the hourly to go short, because you have more potential pips. Let's take a look at this along with the range bars. Sometimes it's hard to find a low risk, high probability entry with minute-based charts, and sometimes tick charts have so much noise that you can get in and out of quite a few trades with some success or a lot of losses. Using a range bar, which hopefully it will come up, this shows 6 pips per bar. So starting the night out, if you wanted to look to sell this, you have kind of like a reverse head and shoulders pattern right here, and so you might have shorted right here. It didn't really fall too much. You can use trend lines to get out. If you went short again on this pullback here, it went your way and came back up, didn't stop you out, barely made a lower low and came back up, so you probably would have got out of that with a small win or small loss. Then you had an absolutely big move up here, but you don't know if that's a trend reversing to the upside. The currency meter still showed the Australian is weak and the yen is strong, so you might wait for a little bit of a pullback, and if the market can't go higher, sell that low there. There's quite a few, as this continues its downtrend, areas to go short. You also see nice, this is about an hour's worth of price data right here. It had every opportunity to go higher, but wasn't able to. Usually once a low is broken, if you get a multi-bar up, 2, 3, or 4 green bars in a row, the first red bar you go short with your stop a few pips above the high. But compared to a 5-minute chart, it gives a lot clearer signals than, the 6 pip chart is much cleaner in many cases, especially when there's a lot of noise in the market. Another one that was weak last night on all time frames was the CAD. So the CAD yen's also very high probability one to be selling, and obviously this there's more than likely a yen, some kind of news announcement for the yen that caused it to spike on most of the pairs. But if you look at the 5-minute chart, you might have sold the low here when it finally broke down. It spent a lot of time there as support. Once it's broken, it becomes resistance. So this trade right here, here, and here. But if you bring up a 6 pip CAD yen chart, it's usually a lot easier at finding higher probability trades. Also, one of the new tools that we're releasing today shows you how many pips each currency moves per day. It's called ATR. When you add this, you can see how many pips each currency moves typically for the whole day, and you might want to divide that by 10 or 15 to know how many pips to use in this chart. The Australian yen 20-day average moves 133 pips a day, so 6 pips per bar is quite fast. You might want to use 13 pips per bar, and as you do, you can see a lot of the noise that's in the market gets taken away. You have a low here that's slightly breaking down, and it obviously broke out to the upside of that, and when that ran out of steam and broke down right here, you can go short with a very logical stop. Because this moves 133 pips per day on average, if you put your stop 2 pips above the high here, you might be risking 15 pips. And you have a lot of upside. You're risking 15 pips. It moves 133 pips a day. You're not likely to catch a 133 pip move, but you can see this one just kept falling and falling. Maybe you got out of the trade right here, kind of chopped around a little bit here and broke down again. You go short and made another 50 pips. But it fell a little over 100 pips there. And so what if you shorted this next move up here? Came down a little bit, you made a little bit sideways consolidation rectangle pattern, you go short, fell 30 pips. And then it didn't make a lower low, so you might want to wait for some kind of a sign, like a double top right here. You go short right here, it fell. Nice pullback right here, it also fell. So it's a lot cleaner than a 5-minute chart. If you look at this, where in the world do you get into this trade? You might have gone in here and here with some decent trades, but the range-based charts are a lot cleaner, a lot less noise. We had a very strong pound last night, and so you could have traded the pound against the Australian or the CAD. Let's bring up the pound CAD, for example. And again, notice all the noise on this chart. Let me add all the currency pairs to this, and we'll see how much the pound CAD typically moves per day. It's probably quite a bit. Pound CAD, 143 a day. So 14 pip per bar range chart. It should be pretty decent. And there's another way of picking how many pips per bar we're going to showcase today, which is a new feature. And so this trend, pound was strong, CAD was weak. You want to buy pullbacks in this, little range patterns like this. The fact that when it did have this nice pullback right here and it didn't break the low, it's a pretty high probability trade, and an absolutely no-brainer right here because it made a higher high. That's always positive. And after a 4 or 5 range bar chopping around in a very narrow rectangle pattern, it's very high probability. You draw your fibs on that and you already have your profit target ahead of time. So you're taking this breakout trade with maybe a 16 or 17 pip stop, and your profit target's likely to be 50, 55 pips. It's just a wonderful way of finding low risk, high probability trades. Another tool that we put in here, and you can put this on any time frame chart. If you want to know, if you want to trade something that looks similar to a 5-minute chart, but it's range based, you can add the script called ATR also, and it allows you to have the average or the median, and it shows you the average 5-minute pound CAD bar is 4.01 pips, but if you trade during certain times of the day, you can see the average for any 5-minute bar. So you might not want to use the average because it factors in some of the low volatility periods. You might want to scroll back and see 6 pips is a reasonable amount for a 15-minute bar. If I want to go to a 5-minute bar. If I want to go to a 15-minute bar, the average during the active times of the day, you might want to use somewhere between 10 and 12. And so, if you're trading the active times, you might want to go with a 12 pip range bar, 12R. And this will allow you, let's get rid of this tool now because it only works on time-based charts. This will allow you to clean up your charts a little bit based on each currency's normal volatility. You have this nice little flag pattern right here, and look at how beautiful the moves are. You get jigged out of trades so often on regular time-based charts because you might have a 5-minute bar that goes up, the next one comes down, then it goes slightly higher, and then it comes down. You might have another bar that comes down. You get jigged out of the trade. Whereas this tends to keep you into the trade. First red bar, put your stop a few pips underneath the low. Wicks tend to be very good at predicting the highs and lows of swings. Notice the wick on the bottom of the bar, it reverses up. Wicks on the top of the bar, it reverses down. Wicks down. This one here did go up about 30 pips, but not enough to totally reverse. It's just a wonderful pattern. Let's look at some of the other trades we might have taken last night. Swiss, very strong. It's probably one of the strongest currencies across the board longer term, but it did have quite a few hours of weakness. But that being the case, very short amount of weakness and some strength, short amount of weakness. It's pretty safe to assume, the strength will come back, especially after an hour right here. So if you see at 9 o'clock a currency that may be strong, but the longer term trend's down, for example, the Australian right here, right? It had, intense weakness for periods of the day, hour and a half of strength. It started to subside here at 9:30. Pretty safe to assume the Australian Swiss will fall. All right, so let's start by finding out what time frame for the Australian Swiss. Let's put a 5-minute chart on here, or actually maybe a 15-minute chart, and we'll put that ATR function on here to see how many pips to make your range bar. So the average for this is right around 7.35, but during the active times of the day it can go up, to 14 pips. Most of these bars are pretty close to the average. You might want to use maybe a 9 or 10 pips per bar for the Australian Swiss. And so after 9:30, Australian Swiss, we'll put up a 10 range bar. And we will go over some of the trades coming up to 9:30. The Australian was weak, the Swiss was strong, and so there's a lot of noise in here. It made a higher high and then pulled back, and it wasn't able to go over this high. You can, just like Renko charts and point and figure charts, you can really see levels very well on range bars. So when it broke down right here, you have a very nice trade. You can see it fell 50 pips. You might have had a 25 pip stop on there. And you probably would have got out of part of your trade here, and when it continued up a little bit higher, you move your stop. Usually currencies that are trending strongly one way or another will make at least 2 waves, so you can use the fib target as a place to get out. And before, we always usually got out of half of our trade at the first fib target and waited for momentum to slow. With these range bars, if it keeps going down, you just, as long as the bars are red, you stay in it. First green bar, you're out, right near the whole number right here. So if you got out of half your trade here and half down here, your average price for your exit somewhere in the middle here, you made about 75 pips on your trade while risking 25. And that's what's beautiful about range charts. You can create a decent size pips movement per bar that equals that currency's average volatility for different times of the day that you trade, or take the daily range and divide by 10 or 15 or whatever factor you find works for you. And the key to trading is small losses, bigger wins. And so when you have logical small stops, the more volatile pairs you have to have wider stops. The less volatile pairs, you're less likely to make as much, so you need to have tinier pip stops. And this keeps the math in your favor.